What if the money in your pocket wasn't just a piece of paper, but a claim to real treasure locked away in a vault? Imagine every dollar, euro, and yen backed by glittering bars of gold, real and untouchable. No wild inflation, no central bank experiments, just cold, hard stability. Sounds perfect, right? Or is it? Today we're diving deep into the story of the gold standard, how it shaped the modern world, why we abandoned it, and what might happen if we tried to bring it back. Because for all its glitter, the gold standard carried massive risks hidden beneath its shiny surface. This matters because how we define money defines how we live. It determines how governments spend, how businesses invest, how individuals save. In a world drowning in debt and worried about inflation, calls to bring back gold are growing louder. But would a gold standard be the solution or a disaster? Imagine trying to buy a coffee or pay your rent based on how much gold your country happens to own this month. If your national gold reserves dropped because of war, a financial panic, or a mining shortage, your paycheck could shrink overnight. Loans could dry up, recessions could become unavoidable. And yet, for over a century, the world has trusted gold as the bedrock of economic life. It promised stability, it demanded discipline, it made money real. But it also chained economies to forces they couldn't control, sometimes with devastating results. Before we dive into modern debates about gold, inflation, and financial collapse, we need to understand where it all started and why the world once fell head over heels for the shiny metal. Next up, how Britain's big bet on gold in the 1800s sparked a global financial revolution and sowed the seeds of future crises. Our story truly begins in 1821, when Britain made a bold move that would ripple across the entire globe. It officially tied its currency, the pound sterling, to gold. No more guesswork, no more fluctuating value. 1 pound would represent a fixed amount of gold, no matter what. At the time, this was revolutionary. Britain had just emerged from the Napoleonic Wars, a conflict that had wreaked havoc on European economies. Inflation had run rampant. Governments had printed money to fund their armies, leaving currencies unstable and trust in financial institutions dangerously low. By anchoring the pound to gold, Britain sent a powerful message. Money would once again be trustworthy, grounded in something tangible and universally valued. Other countries, seeing Britain's booming economy and rising influence, quickly followed. Over the next few decades, Germany, France, the United States, and Japan all adopted some form of the gold standard. This new system brought undeniable benefits. With currencies tied to a single, universal standard, international trade flourished. Investors could move money across borders without fearing sudden devaluations. Inflation remained low and predictable. Ordinary people could trust that their savings would hold value over time. But the gold standard came with hidden costs. Countries had to prioritize maintaining their gold reserves above all else, even if it meant sacrificing economic growth or social welfare. If gold flowed out of a nation due to trade deficits or financial crises, that country had to raise interest rates, cut spending, and even trigger recessions to lure gold back in. In other words, the gold standard demanded discipline, but it also demanded suffering. There was no safety net, no bailout, no stimulus checks. Economic pain was seen as the necessary price of maintaining sound money. And this system, for all its stability, had a breaking point. As global trade expanded and economies became more complex, the rigid gold framework began to crack, leading to one of the greatest economic disasters in history, the Great Depression. Stay tuned as we explore how the world's trust in gold began to falter. The Great Depression shattered the world's faith in the old gold standard. By the time World War II ended, leaders knew they needed a fresh start, something that could stabilize economies without repeating past mistakes. Enter Bretton Woods. In 1944, as the war still raged, 44 nations sent their brightest economic minds to a secluded hotel in New Hampshire. Their mission? To build a new global financial system that could prevent the chaos of the 1930s from ever happening again. Two key figures entered at the center of these negotiations: John Maynard Keynes, representing Britain, and Harry Dexter White, representing the United States. Keynes proposed a radical idea: a new international currency called the Bancor, controlled by a global central bank. White, however, pushed for a simpler plan, one that would cement America's dominance. He proposed making the US dollar the anchor of the new system, backed by gold. White's plan won. Under the Bretton Woods system, the US dollar would be directly convertible to gold at a fixed rate, $35 an ounce. Other currencies would peg their values to the dollar. In short, the dollar became as good as gold, and America became the center of global finance. For the next 2 decades, the system worked surprisingly well. The post-war world entered a period of unprecedented economic growth. Europe rebuilt, Japan industrialized, global trade boomed, living standards rose. This era would later be called the Golden Age of Capitalism. But beneath the surface, cracks were already forming. The system relied on America maintaining vast gold reserves, but as the US spent heavily on the Vietnam War and social programs, more dollars flooded the world. Other countries began to worry. Was there really enough gold to back all those dollars? The tension would come to a head in the early 1970s, when President Nixon made a decision that would shake the very foundation of global finance. Next, the Nixon shock. August 15, 1971. In a dramatic televised address, President Richard Nixon announced a move that stunned the world. The United States was temporarily suspending the dollar's convertibility into gold. In truth, that temporary suspension would become permanent. With the stroke of a pen, Nixon severed the dollar from gold, ending the Bretton Woods system and launching the new era of fiat money. Why did Nixon do it? The math was simple but brutal. America's gold reserves were shrinking fast. Foreign governments, especially France, had started redeeming their dollars for gold. If the trend continued, the US could run out of gold entirely. Faced with the impossible choice between defending the dollar or saving gold, Nixon chose gold. The world suddenly found itself in uncharted territory. Without the gold anchor, currencies floated against each other. Exchange rates fluctuated wildly. Inflation soared during the 1970s. Oil shocks and economic stagnation, stagflation, gripped many economies. It was a painful adjustment. People had trusted that their money was backed by something real. Now, money's value depended solely on government policy and market confidence. Central banks gained new power, but also new responsibilities. They could stimulate economies in recessions, but they could also cause bubbles, crashes, and runaway inflation. Today, we live in the legacy of Nixon's decision. Every major currency, the dollar, euro, yen, and yuan, is fiat money. They are worth something because we agree they are, nothing more. So now, the big question, could we ever go back? If the world is struggling with debt, inflation, and instability, is a return to gold the reset button we've been searching for? Stay tuned as we explore the tantalizing and terrifying possibility of a new gold standard. The world today is filled with uncertainty, mountains of debt, rising inflation, distrust in central banks. It's tempting to look back at gold as a solution, but if we tried to bring the gold standard back now, what would actually happen? In theory, returning to gold would anchor money to something tangible. Governments could no longer print endless amounts of cash. Inflation would likely drop. Fiscal discipline would be enforced, not by politicians, but by the hard math of gold reserves. But the downsides are huge. Modern economies are simply too big, too fast-moving, and too complex for the rigid rules of a gold standard. Global GDP today is nearly $100 trillion, yet the total value of all gold ever mined is less than 15 trillion. To make the system work, either gold would have to skyrocket in price, destabilizing markets, or economic growth would have to slow dramatically. In a gold-based system, central banks couldn't easily respond to recessions. Stimulus packages would be off the table. Economic crises could last much longer, and be far more painful. And politically, it would create massive winners and losers. Countries with large gold reserves like the US, Russia, and China would dominate. Others, especially developing nations, would be trapped. For all its beauty and brilliance, the gold standard belongs to a different era, a slower, simpler world. In today's hyper-connected, high-speed economy, gold offers stability at a price few are willing to pay. Maybe the real lesson isn't about going backward, but finding smarter ways to manage the future.